Welcome back to Investing Talk Podcast.
Today we're looking at advanced micro devices. The big question is it a good time to buy now?
We want to hear from you. Subscribe, like, and comment to support the show. And if there's a specific company you want us to look into, leave it in the comments below.
So let's get into the analysis.
Get it?
You really don't have to look very far to see the bullish sentiment. I mean, the sources are pretty clear. Advanced micro devices is riding this phenomenal wave right now.
Yes, setting a new 52-week high earlier this month, that's a big signal.
It is. And hitting that high right before, critical earnings, it's more than just a number.
Right. It feels like a huge psychological marker. Shows investor confidence is, well, peaking.
Definitely peaking. And it seems driven almost entirely by their wins in AI acceleration.
And we can see why that confidence is so high, right? The news flow these past 3 months.
Yeah.
It hasn't just been small updates.
No, not at all. Foundational stuff. The big headline grabber, of course, was that massive strategic partnership with OpenAI that was announced in October.
That deal, yeah. It wasn't just testing the waters, was it? It felt like a real infrastructure commitment.
Exactly. We're talking deploying 6 gigawatts of advanced micro devices GPUs. 6 gigawatts.
Wow.
That kind of power commitment. It just signals they've moved way beyond being some niche player. They're a real architectural alternative now.
Getting that kind of nod from OpenAI, leader in generative AI, that's basically the ultimate validation, isn't it?
It really is. It says their Instinct MI accelerators meet that incredibly high bar for performance, for scalability in the absolute toughest environments.
And it doesn't seem like a one-off win either. The sources also talked about the expanded collaboration with Cohere.
Yeah.
Late summer, early fall.
Yes, that's crucial too, because Cohere focuses heavily on enterprise and also this concept of sovereign AI deployments.
Sovereign AI. That term keeps popping up.
Yeah.
That feels like a really significant opportunity opening up. You should probably pay attention to that one.
Absolutely. It involves countries, major corporations building their own AI clouds, often for data residency reasons, national security.
So being the preferred partner there makes advanced micro devices look like a politically maybe safer choice.
Yeah.
And technically different.
That's a good way to put it. Safer, differentiated compared to some other big names.
Okay, so that paints a picture of intense future focus, but they still have other strengths, right? Their legacy business.
Oh, for sure. We have to remember the other pillars. Sources point out that even outside the AI spotlight, their EPYC processors still winning critical infrastructure deals.
Like the one with Nokia's cloud infrastructure back in August.
Exactly. So that diverse strength, high-performance computing, telecom, and this surging AI sector, that's why the market's assigning such a premium. They aren't just a one-trick pony.
Winning the data center war on multiple fronts. Makes sense.
Yeah.
Okay, let's maybe pivot from the excitement of the news flow to the colder, harder numbers.
Yeah.
A stock setting highs. Well, it's meaningless if the financials don't back it up. How's the fundamental picture look?
Fundamentally. Exceptionally robust, actually. And it's really fueled by that demand for their high-margin AI infrastructure. Yeah. Their trailing 12-month revenue, TTM, is sitting at $29.60 billion right now.
$29.6 billion. That's significant expansion.
It is, and it's broad-based support, too. Data center, client computing, even gaming segments contributing.
All right, but let's get straight to the elephant in the room. The valuation. Net income TTM is solid, what, $2.83 billion, EPS around 1.73?
Correct.
But that forward price-to-earnings ratio, consensus has it at 46.47. That feels historically high. Doesn't that imply like years of perfect execution ahead?
You're absolutely right to challenge that. That PE of nearly 47 isn't pricing today's earnings.
Right.
It's aggressively pricing in accelerating earnings growth expected over, say, the next 2 to 3 years. The market is betting big on that ramp up of the Instinct MI accelerators.
So the analyst upgrades we're seeing, they're basically betting advanced micro devices successfully steals significant AI market share.
That's the core belief, yes, that they can really take a meaningful chunk of that space.
And where does management fit in? Did their guidance actually support this aggressive view from the market?
Yes, definitely. Management's Q2 2025 revenue guidance, $8.7 billion, was notably upbeat compared to what analysts expected.
Okay.
And it wasn't just slightly positive guidance. They explicitly talked about accelerated sequential and year-over-year growth, driven directly by shipping more of those new AI products.
So when management signals that kind of acceleration, Maybe the high PE looks more like a preemptive valuation, not necessarily overvaluation.
That's the argument, yeah. It starts to make a bit more sense in that context.
And what about funding this AI war? It's super capital intensive. How's their balance sheet look? Can they afford this race?
The balance sheet actually provides critical comfort here. They've got roughly $4.6 billion in cash and cash equivalents.
Okay, healthy cash pile. And debt.
Total debt is comfortably below $2.8 billion, so that means extremely low leverage.
Wow, that's fascinating. In such a competitive, capital-hungry industry, maintaining that kind of low-leverage position is impressive.
It suggests they're funding this R&D war mainly through efficient operations, retained earnings, not just loading up on debt.
Right. And that healthy free cash flow goes right back into R&D.
Directly back in.
Yeah.
Massive reinvestment, and that explains why they pay no dividend.
Makes sense. They're prioritizing every dollar into winning that AI race,
Yes.
extending their roadmap lead.
Which is exactly what a high-growth tech investor wants to see right now. Absolutely.
Okay, that reinvestment leads us nicely into their competitive advantage, their moat. What do the sources say about that? How are they challenging the big incumbents in the data center?
Their edge, their moat, it's really centered on offering alternatives. Technological alternatives in data center CPUs and AI accelerators.
Right, because for years, the market was basically dominated by one or two vendors.
Exactly. Advanced Micro Devices successfully broke the CPU near monopoly with EPYC. And now they're aggressively attacking the accelerator market with the Instinct MI series.
And here's where it gets really interesting for me. Those hyperscale customers, the huge cloud providers, Microsoft, Amazon, Google, they have a strategic need to reduce dependency on any single supplier, right?
Precisely. Financially, operationally. They need a reliable, high-performance alternative. And Advanced Micro Devices is just perfectly positioned to grab that critical second-source business.
So EPYC chips have been gaining share, and now Instinct MI is their best shot yet at the multi-billion-dollar AI infrastructure spend.
That's the play. Their success isn't just about having a slightly better chip sometimes. It's about solving a huge supply chain dependency problem for the biggest tech companies on the planet.
How do the sources differentiate their actual product architecture, though, from the main competitor?
Well, the differentiation isn't just pure speed, though that's part of it. It's also architectural philosophy. Advanced Micro Devices pushes hard on open source compatibility, better memory bandwidth, things developers wanting flexibility might prefer.
Interesting.
And while the sources don't give us like exact head-to-head benchmarks, that massive OpenAI commitment, it tells you the performance is now definitely competitive enough to justify making that architectural switch.
Okay, so we've got a compelling case here. Current wins, strong financials. Let's look ahead. If you're buying the stock today, what catalysts are coming up, say, next 90 days, that could justify a bump?
The next 90 days are absolutely packed. We are really heading into the moment of truth timeframe for this whole AI roadmap.
Okay, lay it out.
First up, Q3 earnings report, scheduled for November 4th.
That one's non-negotiable, right? Yep. The market expects that double-digit year-over-year revenue growth, driven by server and AI. Any weakness there?
Any softness or weak guidance for Q4? Yeah, that could seriously undermine that PE of 46 we talked about. Big time.
And then just a week later.
November 11th. The highly anticipated Financial Analyst Day. This one's critical. Management unveils the deep strategic plans. Investors will be scrutinizing everything.
Especially the innovation pipeline. And maybe detailed shipping schedules for next-gen AI chips.
Exactly that. They want concrete timelines.
So November really feels like the make-or-break month. Two huge events, back-to-back. What else before year-end?
Well, heading into the holidays, around December 20th maybe, we'll get early reads on holiday season sales.
Ah, right. Gaming GPUs, console parts. Not the core driver, but still a useful indicator.
Yeah, helpful for consumer strength, portfolio diversification, and crucially, product launches are set to accelerate.
The next-gen stuff. Instinct MI AI accelerators, new EPYC server chips.
Expected to begin initial shipments, or at least be previewed, by year-end. That moves them from pipeline promises to actual revenue generator.
Got it. And beyond the confirmed stuff, any speculative buzz in the sources?
Rumors. Oh, plenty of that. Unverified rumors about more GPU market share gains. Even some speculative talk of a strategic acquisition to maybe bolster their AI software side quickly.
Interesting. Unverified, but still reinforces that positive expectation bubble.
Exactly. It keeps the momentum going.
Okay, let's turn to the technical setup. Sentiment and price action often drive short-term moves. Stock closed recently, what, $233.08?
Yep, $233.08, which is, as you said, spitting distance from its 52-week high of $242.88.
That closeness confirms massive short-term strength.
What about the charts, moving averages?
From a charting perspective, it's looking strong, trading consistently well above its major moving averages. The 50-day simple moving average is around $179.94.
And the 200-day?
Way down at $134.84.
Okay, trading that far above the 200-day really confirms a powerful long-term uptrend. This isn't just a blip, it's structural momentum.
Agreed.
But we need to check if it's maybe running too hot. Is it overbought?
Momentum indicators suggest there's still potentially room to run. The Relative Strength Index, RSI, is at 63.54.
So, neutral to mildly bullish, hot, but not critically overbought territory yet.
Right. The risk of an immediate sharp technical pullback seems mitigated for now. Trading signals are projecting a near-term bullish range, roughly $180 up to maybe $250.
$180 acting as a strong support floor there.
Seems like it.
And this lines up with what the analysts are saying. Their conviction seems incredibly high.
Overwhelmingly positive, yeah. The composite 12-month price target from the major firms is sitting at $250.22. Some bulls see it going up to $310. And these aren't small shops, right? We're talking big banks.
Oh yeah, UBS, Bank of America, Truist. They have all recently reiterated or even raised their price targets, citing that accelerating AI roadmap, the server strength.
That conviction shows up in institutional activity too. Smart money chasing it.
Definitely. Institutional inflows are elevated. And retail sentiment? Mirror image. Sources report overwhelmingly bullish positioning. Something like 95% of open retail positions are long.
Wow. The market has clearly placed its bets here.
It really has.
But we can't ignore the risks, especially with that high valuation. What are the key downside factors that could, trip up this whole thesis?
I think the biggest risk is the one we keep circling back to. Execution. Plain and simple.
Internally, things like depending too much on a few huge customers or the usual cycles in PC and gaming markets.
Those are concerns, yes. But the absolute critical swing factor is flawless execution on that AI roadmap.
So if they stumble on deploying the next-gen Instinct chips or fall behind schedule,
the market will reprice the stock, partially. That valuation premium, which is all based on future success, gone.
And externally,
Yeah.
macro threats still linger.
Always. Broader sector stuff like U.S.-China export controls that could mess with supply chains or market access. And just general macro sensitivity interest rates could hit all high-growth stocks.
That's true. Though, to be fair, advanced micro devices has shown pretty consistent outperformance compared to peers, navigating challenges well. That diversification helps.
It has shown resilience, yes. Rapid innovation has certainly helped them weather storms better than some.
Okay, so let's bring it all together. Back to your decision as an investor. Based on this overwhelming positive momentum, the healthy financials, that packed catalyst calendar, what's the overall investment thesis here?
I think the thesis remains overwhelmingly bullish. If we had to put a number on it, maybe a very strong rating, like 9 out of 10.
Okay.
The investment case is driven by that structural AI growth, their tech differentiation, and just strong technical momentum confirming the trend. It looked attractive for both, really.
Short-term traders playing the catalysts, and long-term investors wanting AI infrastructure exposure.
Exactly. It fits both profiles right now, assuming the execution holds up.
The upcoming November Analyst Day and Q3 earnings report are likely to define the near-term volatility and whether the market sustains its high PE valuation, making the execution on that AI roadmap the singular most important factor to watch right now.